I'd like to welcome all of you here in person and to our global audience on television and the internet. I'm Craig Snyder, the president of the World Affairs Council of Philadelphia. I want to begin with a wonderful programming announcement. Vice President Joseph Biden has agreed to accept the Council's annual Atlas Award for Humanitarian Service. It will be presented to him in recognition of his leadership of the Cancer Moonshot Initiative, and the event will be held on August 3rd, with details forthcoming to you shortly. I hope many of you will mark your calendars and be back to join us again for that special day. Because of the significance of Dr. Yellen's position and the undoubted significance of her remarks today, we have many new friends participating with us and what I'll call a robust press corps. I'd like to take a moment, therefore, to note how today's program illustrates what we do at the World Affairs Council of Philadelphia, one of America's oldest and premier public policy platforms. Today is the 72nd anniversary of D-Day, a single day on which the willingness of thousands to sacrifice everything gave us the chance to be here on this day. Today, General Eisenhower's grandson, David, who also hosts the Council's public television series, is guiding some other Council members on the beaches at Normandy. That's one thing we do. And in addition to the work that we do bringing global awareness and understanding to thousands of middle and high school students, one of who you will hear from at the end of Dr. Yellen's remarks, we also provide this nonpartisan forum for political and policy debate in the birthplace of modern democracy. Our members have heard me say this many times. The World Affairs Council of Philadelphia is a corner store in the American marketplace of ideas. Many Americans of many different points of view share today a deep concern over the state of our country's public discourse. For nearly 70 years now, the World Affairs Council of Philadelphia has not only urged civil and thoughtful discussion, but we have enabled, emboldened, embodied the care of those ideals. And the institutional memory of this place commands recognition that trials for democracy and for democratic capitalism are the norm, not the exception. From our formative years in the epochal aftermath of World War II, the Council was here. In the 1950s, as an American economic and military colossus bestrode the world, mostly for good, but not always, we were here. On the weekend in 1962, when the world nearly ended, we were here. In 1968, perhaps the ugliest year in American politics since the Civil War, the World Affairs Council was still here. In the constitutional crisis leading to the resignation of a president and the time that followed of a presidentially declared national malaise, we were here. In the 1980s, when an American president loved by many, but also troubling to some, proposed a new approach to diplomatic and national security doctrine, we were not only here, but this organization led the nation's debate on that subject. Then the Berlin Wall came down, and people spoke of the end of history. But this organization looked out and saw a world still fraught with peril, as well as enlivened by new promise. We were here, believing that the need to work for a more perfect republic is a project that should and will never end. So we believe in the teaching from Churchill's credo that democracy is the worst form of government except for all the others. And we've tried to live up to the teaching of democracy for all these years. In the last decade, when America chose its first African-American president, when the Tea Party rose in opposition to many of that president's policies, when both low-intensity but nearly endless war and the chance for major war among major powers have grown, and when a great recession pushed back against generations of economic progress, the World Affairs Council of Philadelphia was here, incubating and curating ideas. And so today, with critical decisions to be made on politics, economics, on the way we relate to one another in our civil society, and on the way we should play a role in the world, we are still here and still standing for the right of ideas to be heard and the duty of all of us to be open-minded listeners. I had the opportunity as a young man to be at the back of this very ballroom watching one of my predecessors as the president of this council introduce President Reagan, Soviet President Gorbachev, and British Prime Minister Thatcher. The things that they said here from this podium helped define our world. We are in for a similarly momentous and memorable occasion today as we engage on the question of the future of the American and world economy and engage with the powerfully impactful views of Dr. Janet Yellen, Chair of the Board of Governors of the Federal Reserve. Please join me now in welcoming Chair Janet Yellen.
Thank you so much, Craig. I'm delighted to be with you today. I will discuss recent economic developments, the outlook, and their implications for monetary policy. My message will be largely favorable, although recent developments have been mixed. Most importantly, the economy has registered considerable progress over the past several years toward the Federal Reserve's goals of maximum employment and price stability. And as I will explain, there are good reasons to expect that we will advance further toward those goals. The news from the labor market over the past year has been generally good, with significant job gains, the unemployment rate declining below 5%, rising household incomes, and tentative signs of faster wage growth. At the same time, recent signs of a slowdown in job creation bear close watching. Inflation has been lower than our objective of 2%, but I expect it to move up over time for reasons I will describe. If incoming data are consistent with labor market conditions strengthening and inflation making progress toward our 2% objective, as I expect, further gradual increases in the federal funds rate are likely to be appropriate and most conducive to meeting and maintaining those objectives. However, I will emphasize that monetary policy is not on a preset course, and significant shifts in the outlook for the economy would necessitate corresponding shifts in the appropriate path of policy. In particular, an important theme of my remarks today will be the inevitable uncertainties surrounding the outlook for the economy. Unfortunately, all economic projections are certain to turn out to be inaccurate in some respects, and possibly significantly so. Will the economic situation in Europe or China take a turn for the worse or exceed expectations? Will U.S. productivity growth pick up and allow stronger growth of gross domestic product and incomes, or instead continue to stagnate? What will happen to the price of oil? The uncertainties are sizable, and progress toward our goals, and by implication, the appropriate stance of monetary policy, will depend on how these uncertainties evolve. Indeed, the policy path that my colleagues and I judge most likely to achieve and maintain maximum employment and price stability has evolved and will continue to evolve in response to developments that alter our economic outlook and the associated risks. The economic expansion following the Great Recession has now been underway for 7 years. The recovery has not always been smooth, but overall the gains have been impressive. In particular, the job market has strengthened substantially, and I believe we're now close to eliminating the slack that's weighed on the labor market since the recession. I will turn to this past Friday's labor market report in a moment, But let me begin with some background. The economy added 2.7 million jobs last year, an average of about 230,000 a month. In the first 3 months of this year, payrolls were growing only modestly slower at a little less than 200,000 monthly pace. The unemployment rate had fallen to 5%, down from a peak of 10% in 2009. In addition, the Bureau of Labor Statistics measure of the job openings rate was at a record high in March, and the quits rate, the share of employees voluntarily leaving their jobs, has moved up, and in March stood close to its pre-recession levels. The increase in the quits rate is a sign that workers are feeling more confident about the job market and are likely receiving more job offers. So the overall labor market situation has been quite positive. In that context, this past Friday's labor market report was disappointing. Payroll gains were reported to have been much smaller in April and May than earlier in the year, averaging only about 80,000 per month. And while the unemployment rate was reported to have fallen further in May, that decline occurred not because more people had jobs, but because fewer people reported that they were actively seeking work. A broader measure of labor market slack that includes workers marginally attached to the workforce and those working part-time who would prefer full-time work was unchanged. An encouraging aspect of the report, however, was that average hourly earnings for all employees in the non-farm private sector increased 2.5% over the past 12 months, a bit faster than in recent years, and a welcome indication that wage growth may finally be picking up. Although this recent labor market report was on balance concerning, let me emphasize that one should never attach too much significance to any single monthly report. Other timely indicators from the labor market have been more positive. For example, the number of people filing new claims for unemployment insurance, which can be a good early indicator of changes in labor market conditions, that remains quite low, and the public's perceptions of the health of the labor market, as reported in various consumer surveys, remains positive. That said, the monthly labor market report is an important economic indicator, and so we will need to watch labor market developments carefully. Economic conditions here in the Philadelphia metropolitan area have improved broadly in line with national trends. During the downturn, the Philadelphia area and the city itself saw unemployment rise by less than it did for the nation as a whole. But unemployment took longer to recover thereafter. In the city of Philadelphia in particular, unemployment was still running above 10% as recently as 2013. But unemployment here has fallen appreciably since then, helped by a revival of residential and commercial construction that's evident around the city. While the general picture of the labor market is largely positive, some people are still struggling. Unemployment rates rose more during the recession for African Americans and Hispanics than for the nation overall. And even though those rates have also come down by more during the economic expansion, unemployment remains higher for these groups. Unfortunately, those gaps have not narrowed noticeably relative to where they were before the recession. Unemployment rates for young African American and Hispanic men without a college degree remain especially high. And one important benefit from further improvement in the labor market would be increased job opportunities for these men and other groups that currently still experience high unemployment. To be sure, many of the factors that contribute to the labor market outcomes of minority groups are not amenable to monetary policy, and measures beyond the scope of monetary policy should be considered to alleviate the economic challenges that these and other Americans face. Education and training are, of course, vital. Later today, I will visit one program that helps workers in West Philadelphia learn new skills and then connects them with potential employers, an initiative in which government, businesses, and local institutions are working together successfully. While the economy has made great strides toward the FOMC's objective of maximum employment, somewhat less progress is made toward our inflation objective. Inflation has run persistently below the Fed's goal of 2% over the past several years, even as the labor market strengthened significantly. Over the 12 months through April, the price index for personal consumption expenditures rose only about 1%. But I remain optimistic because two factors that have been holding down inflation will likely prove only temporary. First, the sharp drop in crude oil prices since the middle of 2014 has lowered prices of gasoline and other energy products, significantly restraining overall inflation. At about the same time, the foreign exchange value of the dollar strengthened, holding down prices of imported goods. But oil prices have stopped declining and indeed have risen from their low point earlier this year. And since the beginning of the year, the dollar has been roughly unchanged against a broad basket of currencies. As the downward pressure on prices from these two forces dissipates, and as the labor market strengthens further, I expect inflation to move back to 2%. Let me now turn to the outlook for the economy. GDP growth was reported to have been relatively weak early this year, but this measure of growth in economic activity can vary significantly from quarter to quarter. Indeed, while spending data for the second quarter are limited at present, recent data on retail sales and motor vehicle sales point to a significant step up in consumer spending and GDP growth this quarter. Stepping back from near-term indicators, I'd like to focus more broadly on the factors likely to affect economic performance over the coming years. Next week, concurrent with our policy meeting, FOMC participants will release a new set of economic projections. Those could, of course, differ from the previous set of such projections in March, but speaking for myself, although the economy recently has been affected by a mix of countervailing forces, I see good reasons to expect that the positive forces supporting employment growth and higher inflation will continue to outweigh the negative ones. As a result, I expect the economic expansion to continue, with the labor market improving further and GDP growing moderately. And as I just noted, I expect to see inflation moving up to 2% over the next couple of years. Let me start with the positive. The increase in employment over the past several years has contributed to higher household incomes and strengthening consumer confidence. If the May labor report was an aberration or reflects a temporary slowdown resulting from the weakness in economic activity at the start of the year, then job growth should pick up and support further gains in income. In addition, rising equity and house prices have helped restore households' wealth. The fall in oil prices has supported household purchasing power as well. Simple calculations suggest that the average household has gained some $1,300 in purchasing power since mid-2014 from the fall in gas prices. With continuing gains in disposable income and wealth, I expect consumer spending to grow at a solid rate. I also expect the housing sector to make further progress. Both home sales and construction have been gradually improving, and residential investment made a notable contribution to GDP growth over the past year. Housing has been supported by low mortgage rates, and while mortgage credit is still difficult to obtain for households with low credit scores or hard to document income, those with good credit histories are generally able to borrow at very favorable terms. And fiscal policy at the combined national, state, and local levels, which subtracted from GDP growth for much of the recovery, is now a small positive. Economists often say, on the other hand, so in keeping with that tradition, I'll now turn to the less positive. Economic developments abroad have significantly restrained growth in the United States over the past year, although I'm cautiously optimistic that these headwinds are now fading. Concerns about slowing growth in China and falling commodity prices, which afflicted global financial markets early this year and thus likely weighed on demand, appear to have eased somewhat. Indicators suggest that foreign economies are growing, if still at only a moderate pace, and foreign financial markets have recovered and stabilized. That said, net exports have been a drag on U.S. GDP growth over the past year and are likely to continue to weigh on growth over the medium term. This drag in part reflects the prolonged effects of the significant increase in the foreign exchange value of the dollar since the middle of 2014, a development that has been particularly challenging for U.S. manufacturers and other firms competing with foreign producers. Although lower oil prices have likely been a positive influence on the U.S. economy overall, they also have had a negative side given the sizable U.S. energy industry. New drilling and energy sector employment have plunged, and the effects have spilled over to businesses serving the energy production sector. But the largest declines in drilling activity are likely now behind us, and with oil prices having recovered somewhat, I expect that oil prices will become less of a factor. Business investment has been weak in the past 6 months or so, even beyond the energy sector, and investment in capital equipment is reported to have declined in the last quarter of 2015 and the first quarter of this year. I suspect there is a transitory element to this weak investment performance, and I expect investment to rebound. But the latest labor market data raise the less favorable possibility that firms may instead have decided to expand their operations more slowly, and I intend to continue to pay close attention to developments in this area. Well, as I said, the positive economic forces have outweighed the negative, and despite the challenges that the economy continues to face, I continue to expect further progress toward our employment and inflation objectives. To be sure, there is considerable uncertainty about the economic outlook that I've been discussing. And as I've already noted, we should expect to be surprised in the future, just as we've been surprised in the past. 4 areas of uncertainty seem particularly salient at present. The first involves the thrust and resilience of domestic demand. The U.S. economy has performed better than many others around the globe, and that performance has relied chiefly on the resilience of domestic sources of demand, consumer spending in particular. So an important question is whether the U.S. economy could continue to make progress amid fairly considerable global bumpiness. I continue to think that the answer to that question is yes, but the weak investment performance in recent months is concerning, and Friday's employment report provides another reminder that the question is still relevant. The second uncertainty pertains to the economic situation abroad. Even though the financial stresses that had emanated from abroad at the start of this year have eased, global risks required continued attention. Much of the turmoil early this year appeared to be associated with concern over the outlook for Chinese growth, which in turn has broad implications for commodity prices and global economic growth. Recently, the renminbi has moved in a more predictable fashion, and Chinese capital outflows have abated. However, it is widely acknowledged that China faces considerable challenges as it continues to rebalance its economy toward domestic demand and consumption. More generally, in the current environment of sluggish growth, low inflation, and already very accommodative monetary policy in many advanced economies, investor perceptions of an appetite for risk can change abruptly. One development that could shift investor sentiment is the upcoming referendum in the United Kingdom. A UK vote to exit the European Union could have significant economic repercussions. A third key uncertainty for the U.S. economy is the outlook for productivity growth. That is, increases in the amount of output produced per hour worked. While the job market has strengthened significantly, GDP increases have been less impressive. That combination of solid labor market gains and moderate GDP growth reflects the fact that labor productivity growth has been unusually weak in recent years, averaging less than 0.5% per year since 2010. Over time, productivity growth is the key determinant of improvements in living standards, supporting higher pay for workers without increased costs for employers. Recent weak productivity growth likely helps account for the disappointing pace of wage gains during the economic expansion. Therefore, understanding whether and by how much productivity growth will pick up is a crucial part of the economic outlook. But this is a very difficult question, and economists are divided. Some are relatively optimistic, pointing to the ongoing pace of innovations that promise revolutionary technologies, from genetically tailored medical therapies to self-driving cars. Others believe that the low-hanging fruit of innovation largely has been picked, and that there is simply less scope for further gains. My position has been and remains cautiously optimistic. There is some evidence that the deep recession had a long-lasting effect in depressing investment, research and development spending, and the startup of new firms, and that these factors have in turn lowered productivity growth. With time, I expect this effect to ease in a stronger economy. I also see no obvious slowdown in the pace or the potential benefits of innovation in America, which likewise may bear fruit more readily in a stronger economy. In the meantime, it would be helpful to adopt public policies designed to boost productivity. Strengthening education and promoting innovation and investment, public and private, will support longer-term growth in productivity and greater gains in living standards. A fourth important uncertainty for the economic outlook involves how quickly inflation will move back to 2%. As long as oil prices do not resume their earlier declines and the dollar does not rise substantially further, my expectation is that inflation will move up to 2% over the next 1 to 2 years. But oil prices and the dollar can move unpredictably. In addition, a further strengthening of labor market conditions would typically be estimated to exert modest upward pressure on inflation over the next couple of years, but such estimates are inherently precise, and the effect on inflation could turn out to be significantly different, either upward or downward, than I expect. Uncertainty concerning the outlook for inflation also reflects, in part, uncertainty about the behavior of those inflation expectations that are relevant to price setting. For 2 decades, inflation has been relatively stable, reacting less persistently than before to temporary factors like a recession or a swing in oil prices. The most convincing explanation for this stability, in my view, is that longer-term inflation expectations have remained quite stable. So it bears noting that some survey measures of longer-term inflation expectations have moved a little lower over the past couple of years, while proxies for these expectations inferred from financial market instruments like inflation-protected securities have moved down more noticeably. It's unclear whether these indicators point to a true decline in those inflation expectations that are relevant for price setting. For example, the financial market measures may reflect changing attitudes toward inflation risk more than actual inflation expectations, but the indicators have moved enough to get my close attention. If inflation expectations really are moving lower, that could call into question whether inflation will move back to 2% as quickly as I expect. Let me now turn to the implications of the economic outlook as well as the uncertainties associated with that outlook for monetary policy. My overall assessment is that the current stance of monetary policy is generally appropriate in that it is providing support to the economy by encouraging further labor market improvement that will help return inflation to 2%. At the same time, I continue to think that the federal funds rate probably will need to rise gradually over time to ensure price stability and maximum sustainable employment in the longer run. Several considerations lead me to this conclusion. First, the current stance of monetary policy is stimulative, although perhaps not as stimulative as might appear at first glance. One useful measure of the stance of policy is the deviation of the federal funds rate from a neutral value, defined as the level of the federal funds rate that would be neither expansionary nor contractionary if the economy was operating near potential. This neutral rate changes over time, and at any given date, it depends on a constellation of underlying forces affecting the economy. At present, many estimates show the neutral rate to be quite low by historical standards, indeed close to zero when measured in real or inflation-adjusted terms. The current actual value of the federal funds rate, also measured in real terms, is even lower, somewhere around -1%, with the actual real federal funds rate modestly below the relatively low neutral rate. The stance of monetary policy at present should be viewed as modestly accommodative. Although the economy is now fairly close to the FOMC's goal of maximum employment, I view our modestly accommodative stance of policy as appropriate for several reasons. First, with inflation continuing to run below our objective, a mild undershooting of the unemployment rate, considered to be normal in the longer run, could help move inflation back to 2% more quickly. Second, a stronger job market could also support labor market improvement along other dimensions, including greater labor force participation. A third reason relates to the risks associated with the constraint on conventional monetary policy when the federal funds rate is near zero. If inflation were to move persistently above 2%, or the economy were to become noticeably overheated, the committee could readily increase the target range for the federal funds rate. However, if inflation were to remain persistently low, or the expansion were to falter, the FOMC would be able to provide only a limited amount of additional stimulus through conventional means. These motivations notwithstanding, I continue to believe that it will be appropriate to gradually reduce the degree of monetary policy accommodation, provided that labor market conditions strengthen further and inflation continues to make progress toward our 2% objective. Because monetary policy affects the economy with a lag, steps to withdraw this monetary accommodation ought to be initiated before the FOMC's goals are fully reached. And if the headwinds that have lingered since the crisis slowly abate, as I anticipate, this would mean that the neutral rate of interest itself will move up, providing further impetus to gradual increases in the federal funds rate. But I stress that the economic outlook, including the pace at which the neutral rate may shift over time, is uncertain, so monetary policy cannot proceed on any preset path. This point is well illustrated by events so far this year. For a time in January and early February, financial markets here and abroad became turbulent, and financial conditions tightened, reflecting and reinforcing concerns about downside risks to the global economy. In addition, data received during the winter suggested that U.S. growth had weakened even as progress in the labor market remained solid. Because the implications of these developments for the economic outlook were unclear, the FOMC decided at its January, March, and April meetings that it would be prudent to maintain the existing target range for the federal funds rate. Over the past few months, financial conditions have recovered significantly, and many of the risks from abroad have diminished, although some risks remain. In addition, consumer spending appears to have rebounded, providing some reassurance that overall growth has indeed picked up as expected. Unfortunately, as I noted earlier, new questions about the economic outlook have been raised by the recent labor market data. Is the markedly reduced pace of hiring in April and May a harbinger of a persistent slowdown in the broader economy? Or will monthly payroll gains move up toward the solid pace they maintained earlier this year and in 2015? Does the latest reading on the unemployment rate indicate that we are essentially back to full employment? Or does relatively subdued wage growth signal that more slack remains? My colleagues and I will be wrestling with these and other related questions going forward. To summarize, I've explained why I expect the U.S. economy will continue to improve, and why I expect that further gradual increases in the federal funds rate will probably be appropriate to best promote the FOMC's goals of maximum employment and price stability. I've also laid out the considerable and unavoidable uncertainties that apply to both this outlook for the economy and to the appropriate path of the federal funds rate. My colleagues and I will make our policy decisions based on what incoming information implies for the outlook and the risks to that outlook. What is certain is that monetary policy is not on a preset course, and that the committee will respond to new data and reassess risks so as to best achieve our goals. Thank you very much.
Thank you so much. The chair has graciously agreed to answer a couple of questions within our time constraints from members and guests of the council. So if we have any questions, let's hear them. Please step up. There are 2 microphones. Please.
First, thank you very much for coming here, Dr. Yellen.
My pleasure.
My question, please. When deciding whether to keep short-term interest rates low, Is your primary concern GDP growth and the unemployment rate over the next few quarters? Or do you also consider the negative follow-on effects that occur much later due to low interest rates, such as, and I'm sure you've heard this a few 100,000 times, if you can imagine consumers getting into too much debt, take advantage of the low interest rates, and we get a step function up 5 years from now of defaults, or defined benefit pension plans having to invest more money into the plan, meaning less spending now, or alternatively underfund and default later, that sort of thing. Do you take that into consideration too? And to what extent do you balance one versus the other? Thank you very much.
Thank you for that question. So the Federal Reserve takes its mandate and appropriate objectives from Congress, and Congress has assigned to us two main goals, namely maximum employment or full employment and price stability. And so that is our focus, and that's what we keep our eyes on. You asked if our focus is just the next couple of quarters, and the answer to that is absolutely no. We are trying to take a medium and longer term perspective in setting monetary policy. We respond, and our views on policy respond to incoming data, such as a surprise like the labor market report last Friday, only to the extent that we determine or come to the view that the data is meaningful in terms of changing our view of the medium and longer term economic outlook. So we are focused on the medium and longer term. And you mentioned various negative impacts of low interest rates, which we well recognize. You, in particular, mentioned the impact on insurance companies and pension funds, the fact that low interest rates can reach entities like those, but also ordinary investors to reach for yield, to take on risk that could ultimately have serious negative consequences. And of course, as we saw, most importantly and dramatically in the case of the financial crisis, such risk-taking behavior when it becomes really excessive has, in the medium and longer term, very serious negative effects for the economy and the attainment of the employment and price stability goals that Congress assigned to us. So we look very carefully at financial stability risks. We try to assess those, and on occasions, I think, we would prefer, I think most of my colleagues and I believe there are other tools that can be used to address emerging financial stability risks, so-called macroprudential or supervisory tools. I would never rule out the possibility that if we thought a stance of low interest rates was giving rise to serious financial stability risks, that could become a factor affecting policy.
Thank you very much.
We'll come over to this side.
Chair Yellen, thank you for your time today. I'd like to ask about the dynamics on the committee and your role as chair, because I think that there's a lot of impression either in the financial media or among market participants that essentially your vote is the one that matters. And clearly you're the chair, but there's also the other people in the room. And I'm just wondering how you view your role in terms of coming into the meeting with an outcome that you're expecting versus sort of judging where the committee is. And I'm wondering if you've faced the situation during your term as chair where you came in expecting one outcome but were swayed by the weight of the committee. Thank you.
Thank you for that. So the Federal Reserve System was intentionally designed to be one where many independent voices and thinkers would come together around a table to work constructively together, but to bring independent points of view formed in part by the contacts that the Reserve Bank presidents, and we in Washington also have some such contacts with our local communities, with businesses, households, consumers in our communities, assessing and bringing to bear information about the economy and the outlook. So I have assembled around the table. At the moment, we're too short. We're at 17. 17 intelligent, thoughtful individuals who come with their own independent thoughts. And I feel my job is to, first of all, add my own thoughts. I'm also thinking about all of this data and what is the right policy, and we share our thoughts with one another, not only at the meeting, but also in the run-up to the meeting and in other occasions. We talk to one another, and I look to achieve a consensus in the committee. Sometimes people dissent. I have had, I believe, as many as 3 dissents on one occasion, and I think some dissent is certainly to be expected in an economy as complex as ours, that sometimes changes in ways that are different interpretations as to what's happening. But I am looking to find a consensus, to try to help form that consensus, and I think my colleagues look to me to explain what that consensus is. I will say that I have never found it a difficulty to be in that consensus myself. So I can't really think of any occasion where the outcome or decision at a meeting is one that I haven't personally been comfortable with. And I think we have come together as a committee, and while there are a range of views and the world hears them expressed, I think we have considerable consensus and respect for one another.
We have time for 2 more. We'll take one from each side, please.
Thank you. My question regards communication and the ability to provide any insight or forward guidance to the financial markets, which are no doubt watching all of this very interestedly. And you referred to the desire to gradually normalize rates to a real normal level, which is above the rate that we see today. And yet with the degree of data choppiness and uncertainty around whether or not some of the recent data is a trend or just an anomaly, I wondered if you could comment on the ability to provide guidance that's any more forward-looking than 2 or 3 weeks based on the data that's coming to the committee. Thank you.
So let me start by saying that the committee frequently refers to this process of normalizing rates. And I think maybe it's useful to make clear that that's not some independent goal of monetary policy, that we have full employment, price stability, and normalization of rates. Most of my colleagues and I believe that in a pretty normal economy, it's likely to be appropriate to have a higher level of interest rates, perhaps not the historical average, but something higher than we've had in recent years. But even that, what is a normal level of interest rates in a normal economy? I tried to emphasize, let me say again, it's something over which we have to be uncertain. There have been shifts in the economy. I think the current level of neutral or normal rates is pretty low. Now, I do believe that will tend to rise over time, which, if it does, means interest rates would appropriately for the economy move further up. But I have to say that is something we're uncertain about and have to find out over time. Now, with respect to forward guidance, I know market participants really want to know exactly what's going to happen. And it is only on rare occasions when we're able to provide that kind of guidance. There is, as I said about 18 times, no preset plan. and we look at data, and we have to rethink the outlook constantly, and in light of that changed outlook, reevaluate. And I really think the best we can legitimately do is explain what factors are guiding our thinking. We do provide detailed information every 3 months. Each participant, and this isn't a committee view, but all 17 participants write down their assessments for the likely path of GDP growth, inflation, unemployment, and the path of policy over the next 3 years that they think goes along with that and is appropriate. And I think that's a lot of information. There is some disagreement, but looking at the central tendency, I think, gives a sense of views. But again, those views change. They're not fixed. And would never say, well, look at the path we wrote down in March, that's what's going to happen, because we constantly have to be reacting to new data and rethinking and questioning things we thought previously. So, you know, I say during the depth of the crisis, we did provide some more concrete forward guidance. And we thought it was appropriate to do that. We, for example, gave various dates and said we thought it would be unlikely, we probably did this in 2011, 2012, that we would be raising the funds rate before mid-2013 or mid-2015, or before the unemployment rate declined below 6.5%. We had the view this was a very unusual downturn, that it would be long-lasting, and that we would need to hold interest rates at very low levels for an unusually long period of time. And without making a promise, we were trying to communicate that view to markets, and it helped because it brought down longer-term interest rates, which helped the economy. But that was a very unusual period.
Thank you.
With apologies to those who won't get a chance because of the constraints of time, we'll take one last question over here.
Thank you for coming. Being retired, being an extreme layman into my economics, and listening to all of the morning shows on Sundays and all the cable shows, and not having any particular interest of the candidates except in economics, and my retirement. They have mentioned, sidebarring, that if the Republican candidate becomes president of the United States, that there is a possibility of an economic crash all over the world because of the world viewing Donald Trump, of how they view Donald Trump. Is this a possibility? Thank you.
An easy one.
I'm sorry, I've got nothing for you on that. You know, we're very focused on doing our jobs, and we'll see what happens.
Thank you.
Just one more moment, if you would. I had mentioned earlier the council's programs for students in middle and high school. We have a representative of our high school program, Remy Hughes, a 10th grader at Girard College, who has a little presentation for the chair. Please, come on out.
Chairwoman Yellen, on behalf of the students at Girard College High School, we would like to present you with a small token of appreciation.
Oh, fantastic. Thank you so much. Beautiful sweatshirt. Thank you so much. Much appreciated.
Thank you all very much. We're adjourned.